Welcome to another episode of the Real Estate Mentor Podcast. I'm your host, Jonathan Clunk, and I'm really excited about the topics that we are going to discuss today. This is the first time on the podcast that we have really had the opportunity to dive into these topics, and we are going to do so with our very special guest, Kevin Bupp. Kevin is the founder and CEO of Sunrise Capital Investments, based out of South Florida. It's a firm that has made significant strides investing in a wide variety of real estate sectors, including office, multifamily, but also mobile home parks and parking lots, to name a few. And that's where we're really going to dig in today. Has over 16 years of experience becoming a leading educator in the niche of the mobile home park industry. And he helps investors achieve higher than average returns. And that is something that piqued my interest, and I think it will yours as well. Kevin, thank you so much for joining us today. Yeah, he's also, I forgot to mention, also a podcast host, also a #1 best-selling author, and we're going to get into both of those today. I encourage you to read his book, to follow him on social media, and listen to his podcast as well. You can never consume too much information from people who are knowledgeable in the real estate space, since that's what you're interested in since you're listening to us today. So Kevin, welcome to the show. I just want to get right in and talk about your background and journey. Mobile home parks are like the #1 thing that stood out to me when I was researching you and in preparation for the podcast. So can you tell me a little bit about how this piqued your interest as well, how you were introduced to this as an investment vehicle? And let's dig in.
Yeah, no, and thanks for having me, Jonathan. Excited to be here. So backing up to maybe the story a little bit before mobile home park. So I bought my first mobile home park in 2011, but I bought my first real estate investment back in 2002 when I was 20 years old. So, I'd done a lot of things leading up to buying that first mobile home park. And, I've owned hundreds of single family rental homes. I've owned hundreds of apartment doors, actually thousands of apartment doors, and then a lot of other things along the way, some office, some retail, some self-storage. Today, I own a litany of other asset classes as well, mostly passive. The primary focus of our company today is mobile home parks, as you had mentioned, as well as parking. And so that's where we spend all of our time on a daily basis. And so as far as mobile home parks, it's always a lot of my stories are always just kind of unique in that, like, I never went seeking for this particular asset class. It kind of just found me in a roundabout way. And so mobile home parks were kind of the same. It's an asset class I'd never considered. I knew somebody owned them. It just wasn't on the radar for whatever reason. And back in late 2010, I was introduced to a gentleman by the name of Randy, just by a good friend of mine. He said, "Hey, you need to meet Randy. He's been a commercial banker 30 plus years. He also owns some mobile home parks, yada, yada, yada." And I had no interest in mobile home parks. I just like meeting new folks and expanding my network. And so I had a lunch with Randy, and we just got talking about basically his career as a commercial banker. And then, he made some comments like, I was always on the wrong side of that P&L. I was the banker. I made good money, but I saw a lot of my clients, I was lending on RV parks and mobile home parks in Florida. Not the only things, but like I had done a lot of loans on those types of assets. And I had a lot of clients that made, millions upon millions of dollars. And I always got to see their P&Ls. And I was just always amazed by the asset classes. So when I retired, I decided to buy a couple of them. And he did. He bought three fairly decent sized RV and mobile home parks here in the Tampa Bay area. And anyway, he just, I was intrigued just first and foremost, because I didn't know anyone that owned these types of assets. And so I just asked questions, and he shared a lot of information. And a lot of information he shared was, it was intriguing, and it piqued my interest in it. And it sent me away from that 2-hour lunch meeting, basically saying, I'm not going to buy more multifamily. I'm going to go buy one of these mobile home parks and see if it's as great as what Randy said it was. And so that's what led me to it initially, and I'd be more than happy to elaborate on maybe some of the highlights of what really intrigued me during that conversation, of what really drove me down that path. And so again, I walked away from that lunch meeting, kind of said, hey, I'm going to learn as much as I can. There wasn't a lot of resources out there about the investment space, about the mobile home park investment space. And I looked at a lot of deals, made a lot of offers. Finally, it took me about 14 months to close on the first one. I bought a really rough REO. This is back in 2011, right? Everything was still very distressed. Bought an REO, pretty much entirely vacant mobile home park up in Atlanta, Georgia, and really owned it up until just a few years ago. And that was the first one. Turned it around, got it stabilized, refinanced it, pulled all my cash back out, and really liked that business model, and bought the next one, and then the third one, the fourth one, and now we've gone full cycle on, somewhere near, I think 20 mobile home parks. Today, we own a portfolio of 18 mobile home parks in a number of different states. We're in the Northeast, Southeast, and the Midwest. And just been a fun asset class, and it's been a fun ride along the way. So I'll stop there and see if you've got any clarifying questions for me, Jonathan.
Yeah, yeah, absolutely. I think there's a lot to unpack there. Randy certainly made an impression on you. And, I think that the old adage is 1,000,000% true that the riches are in the niches. And this is certainly a niche and something that I've heard quite a bit about, just buzzwords over the years, certainly nothing like self-storage. You mentioned that you're in that sector as well. That's something that seemingly blew up overnight. But in spite of that, yeah, mobile home parks are always, I've always heard that they're great investments, but yeah, there's not still a lot of conversation around it. It's still very kind of, for as old as they are, still kind of in its infancy when it comes to getting exposure to mainstream real estate investors or maybe new investors. So let's talk about Randy and what made an impression on you. So obviously he's in banking. He's has his clients coming in, looking at their profit and loss statements, getting a little jealous of the success, wanting to piggyback on that. So tell me, is every mobile home park investment a good opportunity, or are there still different ways that you have to evaluate it that you would not evaluate another real estate opportunity in the exact same fashion?
Yeah, I mean, as far as is everyone a good opportunity? No, not at all. In fact, it's definitely not under the radar anymore. There's a lot of institutional capital that's come into the space over the last 7, 8 years. All the major groups, the Carlyle Group, Blackstone, all those guys, amongst many others, are trying to pour billions of dollars into this somewhat limited industry because they're not really making new mobile home parks, and so there's a limited supply, and it's got this major supply demand imbalance to where there's a lot more demand coming into the space than what new supply is coming out of it. And so that was not the case when I started buying parks. That was not the case when Randy kind of turned me on to it. It was kind of if you knew, you knew, and if you didn't, you didn't. It's just some of a good old boy network. There were a few larger operators throughout the country, but for the most part, it was a, guy that owned a few mobile home parks like Randy, or maybe owned just one, a mom and pop that maybe developed it 40, 50 years ago. It's still in the family. It was very much a fragmented industry. And so, back to the original question of, is every mobile home park good one? Not at all. I mean, it's the same fundamentals apply to mobile home parks as it does to any other type of real estate, right? First and foremost, location, right? It's got to be in a good market, good location that has a demand for what we provide, which is affordable housing. And we've got this affordable housing crisis throughout the country, but there's not an affordable housing need in every part of the country. There's some parts of the country, especially some rural markets or certain, MSAs within respective states that you can still buy a single family home for $70,000, $80,000. You can still rent an apartment for $600, $700 a month. And so I would say that affordable housing is not really key in those markets. And so I probably wouldn't buy a mobile home park in one of those areas. So I'm trying to fill a void. I'm trying to fill the vacuum that exists in a lot of areas, which is quality, clean, safe, and quiet, quality housing at an affordable price. And that's really where mobile home parks come into play. And so we look at a lot of deals, even more so today, because there's so much competition. Again, the secret's out. It's very different today than when it was when we were buying parks, 10 years ago. And, we've got to work really hard to find good opportunities. And even then, when it's in a good market, there's still, we look for value add stuff that we can, buy it as it is today and then make improvements, whether it be lowering the expenses, maybe getting rents up the market, bringing new home inventory in and getting rid of old home inventory, upgrading infrastructure, adding amenities, things of that nature to justify, higher rents, higher overall revenue of the community, which in turn, increases the value. So, but again, yeah, we look at a lot of deals, probably look at 20 deals to make an offer.
Wow.
Maybe make
you
two
look
offers.
At 20 different investment
Yeah, there's a lot of stuff
before you make one offer.
Yeah, there's just a lot of stuff that, maybe it's not a large enough size. Like there's a certain size that we're really seeking. You really gain some economies of scale once you get to a certain size. And so years back, we might have, my first park I bought was only 34 spaces. We wouldn't buy that again today. It just doesn't make sense based on how our company is kind of structured. And it's just, we've got, the pie gets split in many different ways, and it's very difficult to split up a pie that's only 34 spaces. It's much easier to split the profit pie and put resources towards something when it's maybe 100 units or 150 units, right? It's just, you do the same efforts. It's the same energy and effort, same resources that go into that 34 space park as that go into 134 space park. And so we're really looking for larger assets. So a lot of things come across our desks, we just pass it because it's too small. Or on top of that, it might be not in a great market, right? Like we're not really excited about the market. It's not growing. People are moving away from the area. Like we won't buy anything in New York anymore. We had historically, but New York is absolutely no for us for many reasons. One of the big ones being rent control. And so we look at a lot of deals just to find, one that remotely fits our needs. And even then, when we make an offer, doesn't mean it's going to get accepted. So,
hmm
yeah.
So you started with a smaller mobile home park,
Mhm.
about 30 spaces. Would you say that that's probably a good size for somebody who's just getting started in the space, start with a smaller one? Or should they maybe, if they have the capital, take a look at a larger one right off the bat?
Yeah, if they have the capital, I mean, I don't see any drawbacks from going with the larger asset if you've got the means, the financial means to actually to take it down to acquire it. Because again, you're going to put the same energy and resources into that smaller community than you will the larger. In fact, I think there's more benefits to the larger one because if the intent is to fix it and maybe exit out of it at some point in time in the future, you're going to have a much higher profile and better quality buyer for that 134 space community than you might for that 34 space community. The person that's going to be your back end buyer when you look to exit out of that 34 space community is going to be probably a local smaller operator. Someone that's got limited funds, maybe not pay as much of a premium for it because they're just a smaller time operator or smaller time investor. Whereas if it's a larger community, now it's got the awareness and the eyeballs of groups like ours or even larger institutional groups that will pay premiums for good products. So I just think there's, and on top of that, there's better financing. There really is better financing options for larger deals. There's agency financings available, once you get to a certain size, so Fannie Mae, Freddie Mac, they basically have the best rates in the industry, the best ambers, the best loan terms. And it's really difficult to get that when you've got a smaller asset because they typically don't have an interest in loaning on anything that's under 2 million. And even then they're case by case. They really want to do loans that are 4 and 5 million and above. And you're probably not going to spend that much if it's a 34 space community. So just some of the reasons why I think bigger is better.
That's excellent insight, especially from the standpoint of whenever you're turning a park around with the intention of selling in the future and being able to attract a higher quality buyer. Those are some of the things that exit strategy, kind of working towards your exit strategy, entering into the asset with the exit in mind. Those are always really important things to consider, especially as, the economics of investing are changing, especially post pandemic. We'll get into some of that conversation later as it pertains to commercial real estate. But I'm really intrigued by this because this is one topic where I'm coming in completely green to this conversation. And part of the podcast is I love learning as well, along with the people who are listening to this. So walk me, if you will, just at a high level. We don't have to spend a ton of time on it, but the details of evaluating an asset like this and how mobile home parks actually work. Do you own, I guess you own the land? You
Mhm.
own the amenities that you were talking about, and what are some of those amenities? And then also the individual trailers, I guess, are those owned by you, or do you lease spaces to people who bring their own to the park?
Yeah, it's all great questions there. And so in a perfect world, Jonathan, we would simply just own the land and the infrastructure. And then all the mobile homes in the community would be owned by the residents. And they would in turn pay us rent, lot rent, to sit their home on that plot of land and live there. They would be, responsible. And so when it's arranged like that, we have many parks that are just like that. We own 0 homes. All we own is the entire property. We own the roads, we own the water lines, sewer lines. If it has a clubhouse, if it has other amenities like basketball courts, or we have some that have self storage facilities and things like that. Garages. We'll own all that, but they own the homes themselves. So that's the perfect scenario because a couple things. Number one, it's fairly expensive to move they call them mobile homes, but really, like 90. I think the stats show that 98% of mobile homes that go from the factory where they're built to a community, 98% basically stay there until either they don't run out, they don't have like a shelf life. And so like it's not like they go bad after a period of time, right? Just like a normal home, you can renovate things and fix things, but they basically stay in a community forever, or until someone maybe wants to just rip it out and bring a new one in. Maybe they want to upgrade and get the latest and greatest mobile home, right? But they rarely ever move out of a community because it costs a good bit to move. A single wide nowadays, depending how far you're going to go, depending on the state you're in, there's some other factors, but you're talking probably $8,000 to $10,000 to move it and reset it in another community, and then probably roughly double that for a double wide unit, the one that's got two
Yeah.
sections to it. And so,
I think I've seen
um,
them on the back of a lot of semi trucks.
yeah,
So, I mean, that makes
yeah.
sense.
Yeah, and so they don't. So one of the benefits of having it to where the residents own the home, it's number one, they get they maintain their roof. If their plumbing, has a leak, they maintain it. Their AC goes out, they maintain it. We're not responsible for it. But on top of that, when they own the home, they're very sticky long-term residents. It's no
Hmm.
different than them living in a single-family subdivision, because ultimately what happens is if they live there, say for 10 years, and then they get a job change or relocation and they need to move, well, they put their home up for sale like you would a normal single-family home. Another buyer comes along. While this is all happening, they're paying the underlying lot rent. New buyer comes in, assumes responsibility. They buy the home, assume responsibility of that lot rent, and then we never skip a beat. Like it's a beautiful thing, right? We don't have any downtime to renovate a unit or anything like that. And again, we're not responsible for the repairs that are happening as that home ages, right? As roofs need replaced or ACs. But again, that's a perfect world. And so the other side of that spectrum is we do own a number of communities. Mostly it's how we bought them. The prior ownership, maybe at one point in time, many decades ago, they didn't own any homes, but over time, what happens, folks might pass away. Maybe their heirs don't want the home. And so the community ends up acquiring some of the units over time. And ideally, what we normally do when it happens is we try to turn around and sell those units fairly quickly, just so we can get away from the burden of it. But we've acquired many communities where we own maybe as low as 5 units, and then we own some communities where we just bought two communities in Columbus, Ohio. It's 321 lots total. And when we bought that community, it had 200 homes that we ended up owning, that we own out of the 321. The old owner that bought those communities, he bought them out of foreclosure, I think about 12 years ago. And when he bought them, each of the communities was only about 40%. They were developed back in like the early 2000s. So they're actually fairly new communities. And something happened to where the developer kind of lost his shirt, and he only had each community up to like 40% occupied. And so this new guy came in, he bought them from the bank. And then in order for him to, occupy these communities, he just went out and bought new homes. He's over the period of 10 plus years, he bought brand new homes. Instead of selling them, he decided he wanted to rent them. So that's how he did it. So we're converting it, like we bought it with 200 homes. And now over literally the last like 4 or 5 months that we've owned it, we've already sold about a dozen of those homes. And so our objective is to take the renters, either convert them to owners, or when their lease comes up, do some renovations and then turn around, sell that to the end user, so that we can just start eliminating the burden over time that you take on when you own these units. So don't know if that answered your question or not, but
Oh, yeah, for sure. But it also brought up two others. So,
sure.
just slightly in the weeds, but as somebody who invests a lot in single family home rentals, I think that there is some overlap here. So let's say that you're renting the space or the lot to somebody who owns their house. Number one, how do you increase the rent? Is there a rent schedule? Do you have to give them, 1 year, 2 years notice on something like that? And then number two, what happens if someone stops paying that rent and they own their house? Do you then put a lien on their house and eventually, if necessary, force them into foreclosure? What do those two things look like?
Yeah, great question. So when they own their own home, we have a lot lease agreement, just like a standard lease agreement, but it just pertains to the lot that they're renting, that their home's sitting on. Just like a normal lease, we have annual rent increases. Typically, we try to track, CPI or something along those lines. But that's just it. We in every state, really determines how much notice we have to give. It might be 30 days. It might be as high as 90. I don't think we have any states where we have to give more than 90 days notice of a rate increase, but we do it on an annual basis. We do it on their anniversary date of whenever they sign their lease. And like clockwork, we do it every year. As far as if they own their own home and they're paying lot rent, or they decide not to pay lot rent, again, it kind of depends what state's in. But for the most part, generally speaking, we evict them in their home from the lot. And what
Oh,
typically occurs, and the beautiful thing about them owning their own home is most folks that own these mobiles, if it's a decent mobile, then it's probably the most valuable asset that they own. It's probably worth more than their car. And a lot of them, if it's older than 15 years old, they own it free and clear more than likely, right? And so it's the roof over their head. Their monthly lot rent, a very low financial burden. In fact, it's probably the cheapest place they'll be able to find to live anywhere where in the market that they own that mobile home. So like if they lose that roof over their head, then they're going to probably end up spending 2 or 3 times the amount to go find somewhere else to live. And so what happens most of the time when it gets to that point where they own the home and we file an eviction, I'd say about 85 to 90% of them actually figure out a way to make up that lot rent because they're going to lose the roof over their head.
Wow.
In the instance where, it goes all the way through, you know, uh, most of the time if they couldn't pay their rent, they don't have the money to move the home, right? And so they don't have the money to spend $10,000 to move that home to another location. And so there's an abandoned title process. Just like if someone left a car in your front yard, there's that every county and every state has an abandoned title process to where if someone just left a car sitting in your yard, after a period of time, you can go through this abandoned title process and actually get the title awarded in your name, assuming there's no underlying liens or anything like that. And so that's what we do. We do just that. Most of the time it takes about 90 to 120 days. We go through the abandoned title process. We get a new title issued in our name. And at that point in time, we make a determination. Number one, is the home in good enough shape for us to put money back into and then turn around and sell it? Can we get our money back out? If we have to dump 15, 20 grand into a renovation, can we turn around and then sell it to an end user that's going to live there? Can we just get our money back out? We don't need to bring a profit because we make most of our money on the lot rent. That's where a lot of the value is there. We just want to get another homeowner back in there. Or the second option would be the home is a complete dog. That's probably why they didn't care. The thing literally, it's got roof leaks, it's got mold. Like this thing's not worth putting a dime back into it. And so, but we can't demolish it. We can't remove it unless we have ownership of that. So we still have to get the title. And then at that point in time, we basically surrender the title, demo the home, rip it out, and then most of the time we work with all the local dealers. We'll bring a brand new home in and then we'll sell it. Just upgrade the inventory as we go.
This is fascinating. Definitely going to be digging into this topic more following this conversation. Shifting focus a little bit to the other topic that I wanted to discuss with you, parking lots. I live in Louisville, Kentucky. I live in Old Louisville, just slightly south of downtown. I walk downtown all the time. Born and raised here. We are a city that is notorious, at least to the locals, for all of our downtown surface parking lots. Pre-pandemic, it had a lot of support. These parking lots would be full every day with people who were paying monthly to rent those spaces, $60, $120, depending on where it was located. Post-pandemic, a lot of those sit abandoned. I mean, not a single car in there whenever I walk by. And I've seen a few pop up for sale, about $200,000 on some of our commercial listing sites. Tell me about, spend some time telling me how you were turned on to the parking lot industry as well, when you got started, what the landscape looked like and why that was an attractive investment early on. And if that is still the same attractive investment today, if you're bearish on it, or are you bullish on the future of surface parking?
Yeah.
Obviously, it's going to differ by location, but
yeah. Mm-hmm.
Overall.
And just to clarify, we own both surface parking lots as well as parking garages. So both types of parking.
Okay.
As far as how I was turned on to it, just like mobile home parks, a random conversation. My podcast, I really enjoy.
Was it Randy?
No, not Randy, but I really enjoy bringing on unique guests to the show, and I, have had many over the 10 plus years I've been doing my podcast, and I try to find, like, we talk about niches, but I like to find like really narrow niches like that most folks definitely don't ever think about. Like parking lots was one of them. I met a guy at a conference and brought him on the show about 6 years. Maybe it's been 7 years. It's definitely been 6 years. He was one of literally like 4 brokers in the country that specialized in parking assets. And because it's not a huge niche. I mean, there's parking lots everywhere, but a lot of parking lots are owned by municipalities, or a lot of parking lots are, they were built in conjunction with an office tower, right? They might be owned independently. They might be condoized, but they're part of an office tower, and that's like 80% of their demand. And the parking lot or garage doesn't really exist if the office doesn't. It's anyway. It's just there's very few brokers that specialize, and he was one of them. I interviewed him, and I didn't know anything about the niche. Again, just like mobile home parks, I know that somebody owns it. If it's not a municipality, I know that an individual or a company owns it, and I wanted to know about the business model. And what I came to find is that, first and foremost, it was very fragmented. Like the ownership structure was very fragmented, just like mobile home parks. Again, number of institutions that own stuff in like Chicago and Manhattan and all those big cities, San Francisco. But when you start looking at a lot of other markets, even some of those bigger cities, there's a lot of individual owners, a lot of like generational families that have owned a lot of these, parking lots and parking garages. And so that was one part of it, is that it was just very fragmented. Like it wasn't consolidated like traditional multifamily is, or how self-storage is becoming. And so that was intriguing. And the second part was that, given that there was a lot of older owners, again, a lot of mom and pops in the space. Is there wasn't a quick enough adoption of technology. A lot of technology is in the space, but there's a lot of owners that operate parking lots and garages that don't have the latest and greatest technology or have no technology. They've got parking lot tenants collecting money. There's a lot of inefficiencies there, from theft all the way to, not being able to charge based on supply demand cycles. If there's special events happening, entertainment in the evening versus business during the day. There's also low times that they haven't adjusted pricing for. So I saw an opportunity to be able to go buy, just like we buy mobile home parks from operators that might not operate them as well as what they should be, to do the same thing with parking. And, in my mind, parking in most areas, we're very, very picky about where we buy stuff, and how we view it is like, it's got to make sense today as a parking asset, a garage or lot. It's got to make sense today as that, like from a financial sense, it has to make sense today as that. But I want to know that it's in a growing downtown area. It's in a path of progress, because I know that today's use as a parking lot will be literally the lowest value use that it's ever going to see. And so all I got to do is just hold on to it, use it as a parking lot until the day comes when it makes more sense to turn it into something else, right? To redevelop it into whether a mixed use project, multifamily property, you name it, right? But I want to know that it's in a irreplaceable location, but still makes sense today as a parking lot, but will inevitably be redeveloped into something else in the future. Again, we don't underwrite the future at all. It's got to make sense today and in the next 5 years as parking, but knowing that like inevitably it will be worth something much greater at a later date and time. And so
Fascinating.
yeah, so I'll leave it there, and I know that this will go into much more. More than happy to kind of dive deeper as far as kind of how we look at parking, what interests us, because the point you made about downtown Louisville and COVID absolutely kicked. Generally speaking, COVID kicked the parking industry's butt in a very big way. Lots of parking, again, associated with office towers. It's associated with commuters working out of downtown areas, which a lot of parts of the country shut down for sometimes 3 months, 6 months. Louisville really locked down for a long period of time. It sounds like it hasn't come back. I was in downtown Louisville a year and a half ago. Maybe it's been 2 years now.
Really?
Maybe it's been 2 years now, and it was still like we were up and down parking garages. Everything was. It wasn't vibrant. It wasn't. And from what it looked like pre-COVID, right? It didn't have the vibrancy. There wasn't as much traffic down there. I saw a lot of empty parking garages, and that's just unfortunate. And a lot of folks, there's still a lot of pain kind of flushing out of that space. Office parking, there's lots of lots that maybe they'll be worth something in the future, but like there's just no one parking in today. And so we would have a hard time making something like that work. But we only buy in areas, we won't buy any. So like we have 5 unique parking demand drivers. Like it's got to like check all 5 boxes. And if on that box, one of the parking demand drivers is office, that component of it can't make up more than 20% of the overall revenue. And if it does, we have no interest. We just move on, right? And so the other ones being government, like courthouses, sports and entertainment facilities, baseball stadiums, football stadiums, MLB. Anyway, just any type of sports venue. I want to know that it's got transient traffic during the daytime associated with whether it's restaurants, retail, office. And then it's also got a nighttime life as well. It's got restaurants, entertainment, clubs, what have you. It's got to have, hopefully an even keel of all those, where office is the most minimal of all. If it's got a high demand for office, but the office isn't there, then you can't fix that part. Like I can't solve that riddle of getting people back into the office space. And so for example, one of the assets we bought, it thrived during COVID. In fact, it actually did better during COVID than it's doing post. It's still doing great, but it's down here, like literally in my backyard, Clearwater Beach, as the news made everyone aware. Everyone came to Florida during COVID, right? Because we didn't really lock down too much. A lot of folks were going to the beach here outside. So we bought in the beginning of COVID, like in, I think it was like late 2020, we bought a very large parking garage in Clearwater Beach. Had been owned half by the city, half by a private developer. They kind of had a partnership, and we bought that out. And through 2021 and 2022, it absolutely crushed it, because everyone was. Number one, they're not building new parking on the beach. There's a moratorium on parking, so you can't go build a standalone parking garage on Clearwater Beach. And so that's first and foremost. It's got a limited supply. Second to that, a lot of the other surface lots that are in Clearwater Beach, most of them literally are in different phases of redevelopment right now. They're like, in fact, like there's already been like 6 that have gone away over the past 2 years that are now either
Wow.
finished hotel condo projects or in the midst of, right? And so,
Even more limited supply.
yeah, and then a lot of this is countrywide, but a lot of municipalities and local governments are actually removing any parking minimum requirements from new developments. And so, like developers historically used to have to put in a certain number of parking spaces per 1,000 square feet of use. And what we found is that there's just excess parking in many markets across the country, and so they've kind of eliminated that need or that requirement from developers. So developers, if they had an option of either building another 3 multifamily units or 8 more parking spaces, they're going to make way more money by building 3 more multifamily units. So that's what's happening as well. So like there's not a lot of new developments that are occurring like in Clearwater Beach where there's new supply of parking being created. In fact, it's going away, and so it creates more demand for the product. So I know I just gave you a lot there, but like
It
we're
is a
very
lot, but I
selective
mean,
with cities with where we buy.
yeah,
It has to be a
you
city
have to
that
be.
didn't get crushed by COVID because
Hmm.
just I feel that where we're at now in most downtown areas, not that it won't get better, but man, it's pretty much like we're far enough past it to where I think this is pretty darn close to where it's going to be, unless they can, repurpose maybe those office buildings into other uses that will attract more bodies to live and spend time in those different downtown areas, right? Like, we know it's happening, but like it's just not
Hmm.
happening on a large enough scale, and so we won't touch any of this, any of the cities that like shut down for like 2 years, all 2 years or 3 years, because those are the ones that have the worst, office occupancy rates right now. Those are the ones that have retail shops shutting down all through downtown areas because literally there's no people there to support them. I don't know how to fix that. I don't know how to
Yeah.
fix those problems. So
Yeah, you're just providing a service to those people who are coming down there. It's up to everybody else to fix those other
that's
problems.
right. Yeah, and I don't know if some of those are fixable, right? Yeah, I mean, like it would
Yeah,
take a
for
lot of
sure.
time. We bought a parking garage down in downtown Phoenix last year, and again, Phoenix is one of those markets that's booming, and this is right in the heart of downtown. It's literally a stone's throw. I mean, when I say a stone's throw, it's maybe 30 yards across the street from Maricopa County Courthouse, which is the second largest courthouse in the country. So it's got that going for it. It's 2 blocks away from the Footprint Center where the Phoenix Suns play. It's 3 blocks away from Chase Stadium where the Arizona Diamondbacks play, surrounded by retail and entertainment, a hub where there's like, 40 restaurants within like a 3 block radius and a lot of new development happening down there. Right. And so like that's the demand for parking is not going anywhere anytime soon. And Phoenix, again, looking back, Phoenix shut down for a short period of time, kind of like Florida, but Arizona kind of took the same stance as Florida during the pandemic. And so while their downtown occupancy in like office buildings suffered, it's nowhere near as bad as what you might see in maybe a downtown Louisville, or again, name your other city that had shutdowns for multiple years at a time during COVID.
Yeah, definitely not buying a parking lot in downtown Louisville. But if you find the right investment at the right location with, checks most of those boxes, office being the most questionable one, I think it sounds like it's a pretty sound investment. You really clarified in the detailed explanation that you gave, but my question was going to be, or I guess more of an observation that I made. It was, I haven't heard anyone say that they've purchased property for a specific use, but that's actually like the lowest possible use instead of, best and highest. And then with the hope of it being redeveloped into something else or sold to be redeveloped into something else. But then you also at the same time can't underwrite the future. You can't buy on the potential of it. So that adds a lot of complication to finding the perfect investment and the right opportunity. Because, if any of those factors, if you buy something at the lowest use and you have no users, not enough income coming in from that, and it sits forever, you can't sell it to somebody else because everybody else is, bearish on parking. And then it doesn't have the opportunity to be developed into something else, then, you might be sitting on not a worthless asset, but something that's probably going to be one of the lowest performers in your portfolio.
Yeah. So which is again case in point of location, location, location. Like that's first and foremost. You can't fix that. And like the Phoenix one that we bought, we own half a city block in downtown Phoenix, literally surrounded by all the new development that's occurring there. So it's, to think that, again, I guess anything could happen, but to think that that won't be a desirable and a more valuable piece of land in the future as the rest of the land gets gobbled up and gets, built into something else, land becomes even more, it's already scarce there and becomes more scarce. And so
Yeah, both that one and the Clearwater.
Yeah, that exactly. And in the day when cars start flying, we can all argue when that's going to happen, and parking isn't going to be needed. But even in a world where there's autonomous vehicles taking us to and from, and like we don't have our own cars anymore, which again I think we're very far from that. But again, everyone's got a different argument and stance on it. The vehicles still need somewhere to go and stage. Like they need somewhere to go and actually hang out while they're waiting on their next ride. And so there's always going to be a use for highly desirably located land. It's just like, again, maybe it's not parking anymore, maybe it's something else, but it's got to make sense as parking, and there's got to be an opportunity for us to increase the value. So back to the point of the Clearwater one. So one of the ways Clearwater boomed during COVID, so that was one of the ways that this thing did better. But like, we bought it. Cities are just historically bad business owners, right? Like, they just don't make good business decisions. And this is a fairly new garage. It was only built 6 years prior to us buying it. I mean, so it's a fairly new asset. And they were charging, on average $3 an hour for parking when we bought it. They had no adjustments, no adjustments for busy holiday weekends or just weekends in general. Like down at the beach, when you go down there, if you go down on the weekend, most of the lots turn to flat rate parking. Like it's like $30-$40 for the day, and you can go take your stuff to the beach and hang out at the beach as long as you want. But like, you're paying a larger fee than just a couple dollars an hour. But they never made adjustments. They didn't have the good tech. They didn't have updated technology. They didn't. They wanted to give things away for free, but all the while they were basically losing money on this investment that they built. And so the parking rate in the area on average per hour was about $6.50 to $7 an hour when we bought this garage, and that's across all the beach. And then on top of that, flat rate adjustments for higher peak times of the day and times of the year. So we went in and basically just raised the hourly rate from $3 an hour to $6 an hour. That was the first change we made. We put new technology in place, invested a few $100,000 in new technology, adjusted the rates, but then also adjusted the rates according to the amount of traffic that we had coming to the garage on busy weekends and holidays.
Demand.
And so very quickly, almost doubled the revenue. We didn't see any decline in parking because we raised it from $3 to $6 because it's an inelastic demand. People that come down the beach, they've already driven an hour to get there. They got kids screaming in the car, and they just want to park. They want to go somewhere. Kids got to go to the bathroom, right? Like they're not going to not park there because it was $6 an hour, whereas maybe years prior they parked, it was $3 an hour. Because if they go down the road, it's going to be $7 an hour, $8 an hour. It's going to be even more. So, and there's only so many parking lots. Most of them are full. They get there too late. It's full, and they're like, okay, let's just park here. Let's get the kids out of the car. Let's go to the beach. So,
and I mean, I really see the ability to kind of automate the pricing on demand as well.
It is.
The more that arm goes up, you could have triggers in there that says, if it raises just back to back to back 10, 15 times, let's go ahead and raise the price because something's going on. All of that, can be AI generated and figured in. Right. Not to get off topic, but I know the Wendy's, they were playing with the model surge pricing, at times when they were selling more hamburgers, the price would go up. At times when they were selling less, the price would go down, I guess, in order to attract business when it's low and capitalize on it whenever you're busy. So
for example, we have license plate recognition cameras in most of our garages. And so it does just that. So for example, the Diamondbacks went to the World Series a few months back, and in Phoenix at our garage, we started off during the day. The garage will start having people come down a little bit earlier in the day. Like they would come down, at like 3:00 in the afternoon. The game wasn't until 7 or 8 at night, but they come down 3 in the afternoon. And so, but like at that point, the garage had a lot of availability. So it might be $30 an hour then. But as the garage got to like a 40% occupancy, we raised it to $40 and then to $50. But once we literally, by the time we got to our last, literally people that were like procrastinated coming down, like now they're rushing to get to the stadium. They don't want to miss the first pitch. It was $70 an hour, or $70 for the not an hour, but $70 for the night for the last, call it 60 cars that came in, right? And it was all adjusted by software, by the cameras showing us when we were almost full.
Fascinating. So overall, parking lots, mobile home parks, are these more passive sources of income, passive investments than owning multifamily properties with multiple tenants, handling the break fix and all of that? Or is it maybe surprisingly more work, being more hands-on?
I don't think anything's really passive at all. I mean, again, we've got a number of mobile home communities where we don't own any homes there. And, collections are darn near 100% every month. And those are fairly straightforward. Although we do have individual community managers at each location that basically are full time managers, and so they help us with we still get water line breaks, and we have other challenges that come up, and so some are pretty easy and straightforward. But I would say on the flip side of that, there are many that take a lot of involvement. I mean, we in the communities where we own a number of the homes, we're at any point in time, we might be doing 2, 3, 4 renovations, have multiple renovation crews and construction crews in there. We might be doing a lot of improvement projects because you got to think a lot of these communities are large. I mean, these are like 30,
No,
40, 50 acre.
you got to put on your house flipper hat at that point.
Well, yeah, I mean, well, there's just not even just the homes, but even just continual road improvements, continual tree work, landscaping. I mean, there's always something that's needed, some type of upgrade, some type of replacement. That's so like you always have something going on. It's not just hey, we built it, it's going to be perfect forever, and nothing's ever going to happen. Like so, there's always involvement. Surely not passive at all. In fact, I think it's probably a more difficult business than most people make it out to be. There's lots of moving parts because it's not
Hmm.
giving the example of like when we actually have to bring homes in, now we have to sell stuff. We have a whole sales process. Even getting the home in is challenging. Like it's capital intensive. You got to buy homes. You got to get separate financing lined up or have the capital to do it. You've got to get the home set, which is pulling permits. You got to deal with multiple government agencies to get permits necessary to put homes in there. And then on the end of that, you got to actually have you got to have a sales process in place. You got to actually market the home. You got to show it. You got to sell it and help the end buyer get financing on it. I mean, so like it's almost like owning a car dealership if that's part of your model, right? And so
Yeah.
just a lot of moving parts. Some are easier than others, but definitely not passive by any means. Parking's kind of the same way. We in the mobile home park space, we have our own vertically integrated property management company. So it's all like we have I don't know 60 staff, maybe I don't know. It's quite a big part of the company. And then on the parking side, we actually there's a lot of really best in class management companies across the country that are just like they leverage the newest, latest, greatest technology. They're much better and they have the better infrastructure than what we would ever be able to build ourselves, given our size in the parking sector. And so we just go find whoever in these major cities where we own, there's no less than 6 or 7 best in class operators. So we go find the best management company that can handle the day to day. And then we internally have a full-time asset manager that basically, keeps the finger on the pulse of what's going on, pushes them, prods them, gets them to, I guess works the strings, right? But we don't actually have the vertically integrated property management company on that side of the house. So I would say it's a little bit less time consuming from an operational perspective for us because we're having a third party management company handle it. And they got all the staffing. They've got we pay for the payroll, but it's on their payroll. They handle all the, unemployment taxes and
Wow.
workman's comp and all that kind of stuff that gets a little hairy when you've got a lot of employees.
Yeah. HR is a lot to keep up with
It's a ton to keep up with. It's a
when
lot.
that's not your business.
It's probably the biggest headache. I mean, it's really the biggest headache we have on the property management side. It's so staff heavy, and it's just it's a pain, especially when you're in multiple different states. It's a pain in the
Mhm.
butt.
And every state's going to have different laws, different, tax rates, and your one accountant in one state might not be able to, handle every single state that's out there. So then you have multiple accountants, then you have to hire, fire, train.
Yeah. So we have a national accounting firm, one of the bigger ones out there. And so anyway, yeah, that is not the challenge. But I could see where that could be a burden as well. But just having employees that live in multiple different. I think we've got employees now that are in, maybe 14 states. It's just
Mhm.
it's a lot of burden. So
Yeah, you've certainly grown into quite a large operation. I'm looking at it from the single investor who might be looking, to acquire things in multiple states and so on. Helping them to anticipate what some of those challenges might be, because we often don't think about the unseen challenges until you're knee deep in it, and then you have to, make a decision, kind of split second, find somebody. Then that starts cutting away at the profits from
that's
having to
right.
do that because you don't have that vertical integration like you were talking about. Instead, you start to develop this very flat landscape of having to piecemeal everything together. And then all those people, when you don't have a single throat to choke for so many of those things, then
Yeah.
that starts to take up all of your time, answering questions, looking at this, signing off on that, managing the people and even, the companies that you hire to help with all of that. So, wow.
And I think that's a decision someone has to make if they're just getting started. It's like you can do quite well. I mean, like some of the most profitable parks I've ever owned are ones that I bought in the first couple of years. And a lot of it was like I bought them really low because back then it wasn't as priced as what it is today. But on top of that, I was, 75, 80%, in a couple instances, 100% the owner. Right. And so like but it was my project for the first couple of years. It was like, that was my project. But the exit was quite substantial, and they produce, it depends what type of lifestyle that you're looking to live, but you can buy that first park. I bought it with one partner. We were 50-50 in it. I think we got a hard money lender that we had a relationship with. He lent on the park. We put about 300,000 of our own money into it, and it took us about, I think, 16 months until we were able to get it stabilized, do a cash out refinance. We got all of our original money back out of the deal in that first 16 months. And then that thing cash flowed. We put net in our combined net about $100,000 a year, so $50,000 to each of us. Not gonna set any records with that, but it was a really small property. I mean, you could truly, one person could do that one deal, and then they might have to spend 10 to 15 hours a week on it at the most. Maybe not. I wouldn't be the one doing the swinging hammers and stuff like that, but just keeping their finger on the pulse, what's going on, make visits on a regular basis, make sure that it's up to snuff, and they can make six figures on it. I mean, that is quite a lifestyle for many, many folks. Okay. So like it doesn't, you don't have to buy many of these things. You buy the one or two of the right ones. And if you choose to, like, hey, I don't want to have a big company, I don't want to have a lot of staff or employees, you could, again, live a great life and still have a lot of free time on your hands. Once you get it stabilized, probably getting it up to that point, it might, it might be sacrificing quite a bit, but we're at the point now, I think, we went through multiple different stages of the growth of our business, and really my objective, and I've got one other principle of the company. I think our objective is to, you have to make a decision to stay small, or you have to make a decision to actually hire like talented folks in different leadership roles within the organization, which takes quite a bit to where you can even afford to hire those people. Right. So you're still doing a lot of things throughout that time frame. So the last 6 years, we've been wearing a lot of different hats, but we've been slowly bringing in critical leadership roles within the organization, so that hopefully in the next 5 to 7 years, if we so choose, we can remove ourselves and truly sit in more of like a board of advisors role, right? And truly
Right.
have a self-sustainable company that we've got folks that are way smarter than us running the different divisions that have way more experience than we do, but we can just be involved, but maybe have that a lot more of that flexibility back and the time on our hands, and a business that can continue to grow on even without us, having a daily involvement. So that's kind of the plan at this point. But it's not that's definitely not for everybody, and I didn't know if it was right for me for many years, right? So but I think the thing that opened my eyes is we started within the last 3 years. We brought in some incredibly talented folks in different parts of the company, and just watching the productivity that occurs and the growth that occurs once you actually sacrifice and spend the money to bring in that top tier talent. That's a really hard pill to swallow. It's just very expensive, but you get what you pay for. And the growth has been explosive because of that. So a tough decision, but looking back, I'm so glad that we made it. And I'm so glad we're going this path now. Because I think the company and all, I think everyone that works for the company, I think, all of our residents, everyone will benefit from the decisions that we've made over the last couple of years, and that we'll continue to make in the next couple of years.
Win, win, win.
Win, win, win.
And it sounds like you are well on your way to that. So I look forward to watching your continued success and continued growth in all of these sectors and any others that you decide to get into. This has been a fascinating conversation. Do you want to take a couple minutes and talk about your book, talk about your podcast, and your mentorship program?
Yeah. And so just real quick, we don't offer a mentorship program any longer. The podcast, I guess you could say, is it. So I've got 2 podcasts. One that I still do actively, Real Estate Investing for Cash Flow is the primary one. I've been doing it for a little over 10 years now. It's a commercial real estate investing podcast where I bring on folks from a litany of different backgrounds and industries, some that are kind of the primary food groups like multifamily and office and retail, and then many of the niches like we talked about, mobile home parks, parking, and a litany of others that I've interviewed over the years. So I don't know how many interviews I've done now over the last 10 years, but quite a bit. And just to have fun conversations, peel back the curtain, just like we did today with other folks that have built successful commercial real estate businesses. The book is a compilation of all the interviews I've had and kind of lessons I've taken away from the interviews, as well as just my own experience of owning real estate for 20 years. Like I said, I've owned a lot of the different asset classes that exist, and Really, really like that we've focused on manufactured housing, really like parking, but also go into detail in that book about a few of my other favorite asset classes. Assisted living is one of them, self-storage another. And I do like traditional multifamily, although it's having some pain right now in the market. I really do. I understand. I like the fundamentals. I don't think they're changing. I think we're turning really much more into a renter nation. And so I think that it will continue to be a great asset class to invest in. So you can learn all that in the book. In fact, you can grab a free copy of it. You just have to pay for the shipping and hand. I think it's under $7, I believe. kevinbupp.com/free book. And you can get a physical copy, not just the PDF, but an actual physical copy mailed to your door. And I think that's it, Jonathan. And if you want to learn more about what we're doing, so the company, Sunrise Capital Investors, our website is investwithsunrise.com. And we've got a lot of information there. Like, so we spent a lot of time really highlighting kind of case studies of deals, not that just that we own today, but deals that we've historically owned. And we even go into detail with a lot of stuff that we've done we'll provide appraisals, kind of the original business plan, what the ultimate outcome was, financial statements. Like, we put a lot of information up on the website of deals, even deals that we have in our portfolio today, of just kind of, here's the opportunity we saw, here's how we're executing on it. Here's even an appraisal. If it's far enough along, here's an appraisal that basically substantiates the value of it today versus what we paid for it. So anyways, there's a lot of good information like that there. And then you can learn more about investing. If you have an interest in investing with us, there's details there as well. So
you really open up the books on that. I'm definitely going to be checking that out, because that's information that's not, I don't think, readily available many places to the public, all the way down to the appraisals. So I'm going to be checking that out. Definitely going to get a copy of that book delivered to my door and dig into some of your interviews there. So we're going to have all the links in the comments section or below on the podcast. So scroll down there, check it out, engage with Kevin if you like what you heard today or want to explore any of these topics anymore. Kevin, thanks so much for being on the show. We appreciate you being our guest. And thank you guys for listening. We'll be back in 2 weeks with another great real estate topic that you won't want to miss. Again, I'm Jonathan Clunk in Louisville, Kentucky. Follow me on Instagram @TopLouisvilleRealtor. Have a great day.